dear all, welcome back to my YouTube channel Prassimplified. I am CA Prasanna who is passionate in income tax. My purpose of this video is to let you know how the taxation will happen in case of income from house property. Everyone would like to invest their hard-earned money on their dream house, right? And for that purpose, definitely most of you will go towards the home loan. Now the question actually which comes up to your mind is how best can I take this loan and how best I'll utilize this loan towards my house property, and what are the benefits which I'll get in terms of income taxation, whether I should go for a joint loan, whether I should go for a self loan, whether I should co-borrow the loan, whether I should be a co-owner of the loan. All these questions do come into our minds, right? But apart from that, there are also some other crucial aspects which people, you know, not intentionally but unintentionally miss out while claiming the deductions. All those aspects, including the comparison of the incomes when you miss those aspects and without missing those aspects, what impact it will have on your total income, is what I'm going to cover in this video. So please do watch this video till the end for your knowledge purpose, guys. Please do not skip it because each of the slides which I'm going to take are interconnected. So let's move into the slides. There it is, guys, taxation under house property. So let's take a very simple scenario. House property can be of two types: self-occupied house property and house property can be let out. In case of self-occupied house property, you will be getting only interest on loan as deduction, which is say 1,25,000 in this example. Hence you will be always under the loss. Hence 1,25,000 is the loss. Next, house property if it is let out. Let's say you are earning a rent of 7 lakh per year. Municipal taxes, you'll be getting a deduction under this. So 1,500 is deducted, 6,98,500 comes up to gross annual value, and Income Tax Act allows 30% flat deduction after this, which will be 2,09,550, and interest on loan you are paying 1,25,000. Hence taxable income comes to 3,63,950. Very simple calculation. Only thing which you have to keep in mind is that municipal taxes which you are paying is allowable as deduction only if your house property is let out. It will not be allowed in case of self-occupied house property, but interest on loan for both of them will get, and deductions under section 24, it's eligible only for house property which is let out. So now let's say some crucial factors. If self-occupied, interest on loan deduction will be maximum 2 lakh rupees. Okay, that will be the limit which is prescribed under the Income Tax Act. So here let's say 1,25,000 was there. So since it's 1,25,000 it is allowed, but if it's about 2 lakh it would not be allowed. It would be only up to 2 lakh rupees. Clear? Next, if let out, that is house property is let out, then interest on loan deduction will be unlimited, guys, unlimited. So in this case where you can see 1,25,000, even if it was 4 lakh, 5 lakh, 6 lakh, 7 lakh, still the interest on loan would be eligible because there is no restriction on that. Next, will the interest on loan taken from friend be eligible? Yes, it will be eligible, but if you are taking principal, if you're paying the principal of the loan, that will not be eligible. Only the interest on loan will be eligible, because for principal portion will be covered under section 80C, and that necessarily requires you have to buy it from the housing, the bank or the financial institutions. And whether pre-construction interest will be allowed. What is pre-construction interest? The interest which is paid when the house property is under construction. That time you will not get any deduction, but you will get deduction of that amount when the house property is completed. Thereby whatever you pay as pre-construction interest will be allowed as deduction from the year in which the house property is completed till the next 5 years in the 1/5 proportion. So each year, let's say 1,50,000 you pay in total, so 30,000, 30,000, 30,000, 30,000, 30,000, that 5 years you'll be getting, right? Next, let's say you are incurring stamp duty, registration charges, etc., what you paid on the purchase of house property, that is also eligible under section 80C. People do really miss out on this aspect too. So I would just want to stress it on that you can claim it over here in the 80C. Next, whether processing charges is allowed as deduction. Really very important, guys. On this processing charges, many people do really miss out to take this deduction. yes, processing charges is allowed as deduction under the house property. Where it will come, I will want you to take you to the earlier slide. In this thing, you can see the interest on loan, right? So what section tells is interest includes every other charges which is incurred directly in relation to the loan which is levied by the bank. Hence, processing charges or any other service charges will be allowed as deduction. Let's say you go to a bank and ask for a bank loan interest certificate. They will give you interest certificate. You will claim interest on loan, but that will not consist of processing charges. So you have to separately claim it, or you have to obtain a bank statement and then claim it. So please do keep in mind that you can also claim processing charges as well as any other service charges along with this interest on loan. So interest, in the sense, everything is included over there, right? But there are some other charges which you cannot which is not allowable, that is penal charges or interest on interest charges, right? That is not allowed. And whether interest on housing loan is necessarily on paid basis, no, it is allowable on accrual basis. The moment interest is charged to your bank account, gone, that is it is allowable as deduction. So no need of paying it, but principal amount necessarily has to be paid. Only if it is paid, that is allowable. The principal amount of loan which you are doing, right, that necessarily has to be done on paid basis. Next, loss from house property. Okay, if you are incurring some loss from house property, can it be set off against other head of income like a salary or business or profession, etc.? Sorry, yeah. Okay, right. Yes, you can set it off, but only to the extent of rupees 2 lakh. Let's say interest on loan amount is say 3 lakh rupees. Okay, sorry, interest on home loan say 3 lakh rupees. So only on 2 lakh you can set it off against salary income if you have sufficient salary income, and the rest 1 lakh rupees will be carried forward to the next year. Very important. Next one, what is the impact if processing charges is considered, and if it is not considered, I will be telling you. So income from salary 6,50,000 each. Income from house property, in first scenario 1,25,000 there is a loss, in second scenario 75,000 there is a loss, because the difference is 50,000 processing charges which are not considered in second scenario. So gross total income 5,25,000, 5,75,000, then 30,000 each you are claiming as deduction for the principal amount of loan or whatever it is under ETC. So 4,95,000, 5,45,000. So on the first scenario, your tax liability comes up to 12,250 on the application of those slab rates which is there in the picture, and there will be rebate of 12,250 rupees, because maximum rebate allowable is 12,500, and since here 12,250, it is fully allowable, so tax payable is nil. Let's take the next scenario where your total income is 5,45,000. So up to 2,50,000 nil, 2,50,000 to 5 lakh at 5%, 12,500, 5 lakh to 5,45,000. How much is the at 20%? How much it will come? 9,000 rupees. So total tax comes up to 21,500, guys. But you will not get a single rebate. Why? Because your total income is up to 5 lakh. I have told in the first PPT, I mean the first video itself of mine, that up to 5 lakh if your total income is there, you will not be eligible for a rebate. So cess will be added of 860 on that to 21,500 rupees, which is calculated on 4%. So final tax will be coming up to 22,360. So there it is, guys. Just because you missed claiming those processing charges which I stressed on again and again, you have finally paid an extra tax of 22,360 rupees. So please do keep in this mind. Next one, whether it is beneficial to be a co-owner and to be taken a joint loan. I'll be taking some scenarios on this, guys. Yes, let's say Mr. A and Mrs. A are both co-owners. That is, Mrs. A is a spouse of Mr. A, and they are both co-owners of house property. There's 50% share each, and have taken a joint loan. Both are eligible for both interest as well as principal deduction as per the proportionate share, that is 50%. Let's say Mr. A is the sole owner, but he has taken a joint loan with his wife. Whom will be the deduction allowed to? Only to whom the owner is actually, that is Mr. A. Sorry, Mr. A. Okay. So only for Mr. A the deduction will be allowed, even if Mrs. A pays the loan, still both of them will not get the deduction. I will tell you why. Because Mr. A will not get the deduction because he has not paid the loan, and Mrs. A will not get the deduction because she is not the owner itself of the property. So please do keep in mind that to be taking a joint loan and to take the benefit under house property, you have to be necessarily be a co-owner, that is owner, and not only taking a joint loan. Both you have to be a co-owner as well as you have to be taking a joint loan from the bank. So please do keep this in mind, guys. Next aspect, which is better, self loan or joint loan? Let's take an example. Total interest is 1,80,000, total principal is 60,000, and spouse is working. Yes, why I have taken this? Yes, because if your spouse is not working, definitely self loan is beneficial, because your spouse is not at all earning any income, right? So this will be the beneficial. But in today's world, everyone wants to work. Both husband and wife works in a family. So keeping those aspects in mind, I have taken a very beautiful scenario and a very beautiful comparison in the next slide. Let's go into it. So let's take, in the first scenario you have taken a joint loan, in the second scenario you have not taken a joint loan, that is you have taken a self loan. Okay, both are working, Mr. A, Mrs. A. Mr. A is earning 6 lakh, Mrs. A is earning 5,70,000. Interest on loan 90,000 split, because 1,80,000 I told 90,000 will be splitted, and gross total income will be coming to 5,10,000 and 4,80,000. Deductions, let's say 30,000, 30,000. Total income will be 4,80,000, 4,50,000. Both are below 5 lakh, nil taxation. Then come into the second scenario, 6 lakh, 5,70,000. All the interest is paid by Mr. A. So 1,80,000 only he will get. Other income is 0 and gross total income will be 4,20,000. But hers is 5,70,000 and 60,000 again. So here in this example, what you have to remember is Mr. A is the sole owner, right? Mr. A is the sole owner, and since he has paid the whole of the interest and he has paid the whole of the deductions under principal, right? So everything is allowable only to him, right? So 60,000 is allowable only to him, and the total income comes up to 3,60,000. So tax thereon will be nil. But in case of Mrs. A, the total income will be 5,70,000, and tax thereon as per her slabs will be 27,560. Again, by taking a joint loan, you have saved tax of 27,560. So if you had not taken a joint loan, you would have paid extra 27,560. So these aspects, so please take 5 or 10 minutes extra to think before taking a loan, and do some preliminary calculations as to these aspects, who is working, who is not working, all those things, and see the deductions aspect, and then decide on whether you have to go for a joint loan or a self loan. But if you are falling in this kind of scenario, please do go under a joint loan aspect. Next, there are few conditions to claim ATEEA. What is ATEEA? That is, extra interest on loan deduction will be allowable for first time home buyers. So these are the conditions. The loan has to be taken between 1st April 2019 to 31st March 2022. Stamp duty value should not exceed 45 lakh rupees. You have to be a first time home buyer, and loan has to be taken from financial institution, and maximum deduction will be 1,50,000. So this 1,50,000 is separately allowed other than the normal interest on loan deduction which you had taken earlier, that is under the house property. So this is an extra deduction you will get, 1,50,000. Obviously you would have to incur this. Without incurring, you will not simply get extra deduction. You would have to incur this. Once you incur it, if it is not sufficient there, because there 2 lakh was the limit, right, for self-occupied house property ka interest on loan. So now extra 1,50,000 you will be getting over here. So that is the benefit which is given by the government for the first time home buyers. So these are the very simple things which I wanted to share the really misconception. If you really do like whatever I have shared, and if it was very informative or something additional you have learned, please do subscribe my channel, guys. Thank you.